Today we're going to talk about essentially the benefits of investing in the States and doing business in the States as a non-citizen, non-resident, and how to preserve those benefits if you'd like to move to the States. We have a number of clients, really every month, that invest in the States, have investments elsewhere, operate businesses, sometimes in the States, often in South America or Spain or Europe or the Far East. And the kids typically want to go to school in the US. And what happens is the kids often develop a life in the US, maybe marry someone from the US, this type of thing. And the matriarch or patriarch really wants to be with the kids and kind of wants to organize things on the international wealth and business and move to the States. And the idea is, how do we preserve a lot of the benefits associated with being foreign while allowing that matriarch or patriarch to move to the States? So we have an agenda. It's a fairly straightforward agenda. We'll take about 50 minutes, 50 minutes today, and then we'll take questions. We'll do a background. We have a variety of people on the line, from what I understand, from tax experts to people just interested in the topic. So we're gonna range from very simplistic ideas to very sophisticated ideas. If you have a question, you can put it in the chat in the question box. I'd be happy to answer even during the presentation, no problem. Tony will also let me know. Sometimes I miss it. If I miss it, don't get upset. Tony will grab it and will answer you right away, or you can wait till the end, whatever you like. We're going to go through how U.S. basically transfer taxes work, both on the gift side and the estate side. Is there any significant difference when we utilize trusts? And then we're going to talk about, okay, what happens if I'm purely international? What if it's an individual or business and the individual has investments in the US? We're talking about the income tax. We're going to talk about the estate tax on the individual. And we're going to talk about how to avoid any tax. And then if the individual decides, okay, look, I really want to come into the States, what's the roadmap for doing so? How do we plan? What if, like many clients, some of these people don't really want to take no for an answer or plan. What if we can't plan? What if we don't have time? What would we do in that case? What do we give up? What are our options? And how do we address them in a way such that we don't get crushed on the tax side and we can still come and live with our kids who move to the States? So this is your taxation of trust. It just is an overview of your wealth taxes. There's an estate tax. This is basically your assets you die with. Gift tax, what you give away. And what we're talking about, of course, are assets associated with the United States for foreign people. For US people, it's assets everywhere. We're going to touch on the generation skipping tax, which is essentially a broadening of the estate and gift tax, where you don't give to your kid, you give to the grandkid. Well, you're taxed on that because they don't want you to skip the generation. If your son or daughter had given to their son, they're taxed on the gift, so you get double taxed. We currently, the reason we really focus on highly wealthy people associated with transfer taxes, what I mean by transfer taxes is estate and gift tax, is at this point, now that in 2026 it's going to get rolled back, but at this point we're looking at a $13 million exemption. And the $13 million exemption is not per husband and wife. It's per individual. But in order to get that exemption, you have to be a resident or a citizen of the United States, right? A lot of times people will say, well, I just want to give $17,000. That's your annual kind of freebie amount. sometimes even very wealthy people are under the impression they can only give $17,000. So $17,000 is the amount you can give to as many people as you want, and you don't have to tell the IRS. It's an exempt amount. It doesn't reduce your 13 million. So it's kind of you know, a baseline for gifting that you don't have to report. But when you're really planning and you're really gifting and you're wealthy, you really have to try to use up this $13 million per spouse because it's as high as it's ever been. It's very, very high, and it's going to regress back to an adjusted $5 million in 2026. So we really want to utilize that now if we're dealing with a U.S. citizen or a U.S. resident. This is a little bit on the gift tax. The gift tax and the estate tax are combined in that credit, that $13 million credit. So you can give during your life and it reduces the credit. There's no tax until you get to zero on the credit. And then when you die, they apply it again. Whatever you have left of the credit, they'll apply on all your assets, not just individual gifts. A lot of times, and the reason I mention this in the slide is we may not want to complete a gift, especially if we're using a foreign trust. There's an implication associated with the completed gift for people in the US who use foreign trusts because of this idea that we're going to explain, where if we move assets offshore, typically if you're US and you move assets offshore, you're doing it for asset protection purposes and not for estate planning or tax planning purposes. But if you do it for tax planning purposes, in other words, you move those assets out of your estate by completing a gift, there's an implication to it when you die. So we're going to talk about that. And I don't know why this part gift, part sale is there. If you sell your asset to a child and you give them too good a deal, it's part gift, and that'll be applied against your unified credit. And here's the GST I had mentioned. If you skip over to the grandkids, there's an additional tax that applies. It's the same rate and format as the estate and gift tax. So on domestic trusts, just for background, trusts are, they're not a business entity. They're an arrangement. So you basically are funding a trust for a trustee to be control to have dominion and control over. That trustee does not have access to trust assets as a beneficiary. So that trustee is in control and makes decisions with respect to the assets for the beneficiary, your child, etc. The beneficiary, though, has no ability to reach into the trust unless the trust says they can. The actual words of the trust say they can. But from an asset protection standpoint, we want generally to provide the trustee with discretion on making distributions, and we don't want the beneficiary to have access in. So if the beneficiary is sued on any matter, there's no ability to get to the assets. The beneficiary does not have the ability to reach in and grab assets. Therefore, a creditor of the beneficiary cannot get to assets of the trust. That's kind of the basics on the asset protection, the divided title of trust, but they're treated as a separate taxable entity, an irrevocable trust, unless we decide when we create the trust and fund the trust that for income tax purposes, it's as if we did nothing. So sometimes we can create a trust. It's a valid trust. It's asset protection. You know, valid. It works for asset protection purposes, but for income tax purposes, we funded the trust for someone else, but we continue to pay the income tax on the money. What's interesting about those arrangements is that if the grantor continues to pay the income tax on the money, there is a payment on the income to the government, but it's not considered a gift. It's not considered a gift. You have to set up the trust with certain words to do that, but it's very viable. It's very, very effective estate tax plan. So when we get into U.S. international tax, we do it through comparison. So when we say U.S. people, we mean citizens of the U.S. in terms of income tax, And then we mean residents. So citizens and residents are taxed on all their income all throughout the world. So we have to be careful when we have someone coming in from Brazil that they understand that if they're here a certain number of days or they get a green card, that it's not just the income in the States that's taxed. It's the income all over the earth. Now, some countries we have a treaty with, so we can limit that double taxation, but there's no treaties, for instance, with South America. And so we have to be very careful when we come in that we don't stay too many days in the US. There's also a weighted average over 3 years. And of course, there's a green card rule. Once you get the green card, you're taxed worldwide. Most interestingly, most foreign clients more or less understand that and follow what's called the cocktail party rule. The cocktail party rule is a 120 days. You don't want to exceed 120 days in the US in any calendar year. That 120 days has to do with the fact that if you just follow that, you won't slip into an average that brings you in as a resident. That's the income tax side. And then my screen's slightly blocked, but I think this is the estate tax side. If on the estate tax side, I had mentioned you get that huge $13 million exemption if you're a US resident or you're a citizen. But the determination of whether you're a US resident is unrelated to the income tax determination. Every week we have people come in to say, look, I've got hundreds of millions of dollars or whatever the number is, but I wasn't here 120 days. It's not relevant. It's not relevant to the estate and gift tax side. The idea on this one is you got to be very careful. It's a totally different determination. It has to do with arriving here and wanting to stay here, intending to stay in the US indefinitely. Once you arrive and you intend to stay indefinitely, you're an estate tax resident. What does that mean? It means that when you die, right, you are taxed worldwide on all of your assets, even though you've got a mansion in Portugal and 2 businesses in Brazil and whatever else you've got on earth. You're going to be taxed at a 40% rate on that over the 13 million. Now, some people come in intentionally because they have under the 13 million and they have US situs assets. So I'll get to it here in a second. They come in intentionally to get the $13 million credit, but that's not true for ultra wealthy people. If you're US, this side kind of hits the US again. If you're US, you get the $17,000 exemption. Was that annual? You get the $13 million total each, husband and wife, but you get portability. You can give everything to your spouse and there's no tax. You don't get that if you're not a resident or a citizen. So if we decide, well, we're not going to come into the States as a domicile, someone international who decides, okay, I'm going to come into the States and stay, and that's where I'm going to live. If we don't do that, and we have assets in the US, we're taxed only on the assets that are in the US. Okay? So in that case, we just have to be careful what we have here because there's no $13 million exemption. You only get a $60,000 exemption, right? On the income tax side, which is this slide, foreign people have very, very valuable advantages that they can take as opposed to US people. On the income tax side, foreign people who are not here the certain number of days. Remember, this is the income tax at a certain number of days, can sell stock and intangibles free of tax. So we recently had someone come in who bought Apple stock on the uptick, in 2008, 9, and 10. I think they spent 800,000 and they had like $32 million, some outrageous capital gain. They're not taxed on the capital gain. A lot of Americans don't know that, but this is something that the non-resident, non-citizen is pretty aware of, and that's that 120-day cocktail party rule. So they made that transaction and liquidated that and made sure they don't bring that gain in, because once they become U.S. resident for income tax purposes, they're subject to the capital gains, right? We also have treaties with some countries, mostly European countries, and I think I actually have a slide on who we have treaties with here. And then the same applies to foreign trusts. It's like a non-resident, non-citizen of foreign trust. So what are some of the strategies that we can deal with as non-resident, non-citizens on the estate and gift tax side? Well, there's one really obvious one. Okay, and this is before we're thinking about, okay, my kids went to school in the US and I want to move to the US. This is just as a foreigner who invests in the US, we're not sure what we're going to do. Well, your estate only includes what's in the US, right? So let's use a loophole that has existed for, I think, 60 or 70 years now, where we create a foreign entity that's a C, it's taxed as C by the US, and use that entity that doesn't die to own all of our US holdings, right? So what we buy in the US, we buy in a foreign entity. And a lot of people come in, it's too late, and they bought something in their own name, much more complicated, especially if it's real estate. We have some transfer tax issues sometimes in that regard. But if you come in, you already have your foreign entity set up and you start opening your brokerage accounts and you buy real estate, there's no estate tax when you die. That's it. It's over. There's no estate tax when you die. This is not for people who come into the States later. This is if you're just foreign, you create your foreign entity. Your issue with the US is kind of over. You have to pay US income tax if you earn money, but no, there's no estate tax. And you can gift, you can move around the end, you can do whatever you want unrelated to the US. There's sometimes an opportunity to sell the foreign entity. If you can sell a foreign entity, you can avoid any FERPTA, which is the sale of real estate. There is a tax on sale of real estate, but if you sell a foreign entity, there's no tax. It's very uncommon that it works out though, because people don't want your foreign entity in general. So there's your overview. If you are dealing with the estate tax, you're non-citizen, non-resident, you create the foreign entity, you eliminate the estate tax. You still have the income tax, but that's kind of your no-brainer on that. If you haven't created the foreign entity, you've got only basically a $60,000 credit. Anything over that is taxed at 40%. You have to act. You have to deal with that. That is a problem. If you die, you're going to get hit at 40%. We fairly recently had a couple come in, purchase a very expensive home, $6 million home, and mom unexpectedly died, and they were non-citizen, non-residents. Well, what happens is we take the IRS says, oh, hey, it's worth $6 million. We're not going to counsel you. We're just going to tax you. So you didn't come in, you didn't seek counsel, you didn't put it in a foreign entity. So now $3 million is taxable because there's no portability between spouses, right? $1.2 million tax bill for absolutely no reason. And here's the no portability. And you may have a treaty in some countries. You can give gifts at the $17,000 tiny gifts to whoever you want from the US at no tax if you're foreign. I think this is a little more on the estate and gift tax. One interesting point on this slide is that if you do happen to have intangibles, in other words, you own stocks and bonds in the US, you can't give them away. There is an exception for giving away stocks and bonds in the US. There's no tax. It's what we had mentioned with that Apple stock, but it's also a means of transferring stock on the gift side. There's no gift of intangibles either into the foreign entity. So if you have intangibles before you die, get them into the foreign entity. It's very easy. And then when you die, there's no tax. You see how we're doing on time? We're doing pretty well. We've got about 25 minutes. In terms of foreign trusts, you're basically looking at creating an entity that is going to be taxed independently. It's considered a non-citizen, non-resident for estate and gift and income tax purposes. So what that means is very significant, because kind of the idea of the person, the strategy is, when I come into the States, I've been operating and I've got all these assets and I just really want to live here permanently in the States, is what vehicle do I use to leave the assets behind? So if I can leave the assets behind in a foreign entity, what benefits do I get? Well, the US has no interest in foreign income earned on foreign assets. They're not going to tax you if you're a foreigner. They're also not going to tax you when you buy and sell stock. There is a tax when you buy and sell real estate, but not intangibles, right? So you're really, when you create a foreign trust, you're really creating like a foreign person. And the IRS knows this. So it's pretty tightly regulated. And what we'll do is we'll walk through how they try to catch people when they move to the States. So we do have to kind of go through what is a foreign trust. Basically, a foreign trust fails one of these tests. In other words, if a U.S. court cannot rule on that trust, essentially what that means is the trust was formed somewhere else, and the law binding the trust pursuant to its terms is foreign, right? It's a foreign trust. Or if the trust is controlled by someone outside the U.S. jurisdiction. This comes up from time to time where you have a family with multinationality people in it, and the U.S. group says, well, we're going to make Joe in Holland our trustee because we trust him. Uh-oh, boom. Now Joe, who's a non-resident, non-citizen, is the trustee. Now you have a foreign trust. So if we're U.S. and we unintentionally make a foreign trust, it's not the end of the world usually, but the compliance is very, very heavy, very, very heavy. You have to be careful with that. You could trigger some tax. On the U.S. grantor side, if we create a foreign trust, it's usually for, as I had mentioned, for asset protection purposes. Essentially, we move the money out so that the U.S. court cannot attach the money. We like Nevis, Cook Islands is good too. But we have to be careful on the tax side, very, very careful on the tax side. So what had happened over the last 15 years is there was a number of regimes in place, but now the regime is if you transfer out to the foreign trust and you have a U.S. beneficiary, so either the grantor or a child or whatever is in the U.S., everyone's essentially U.S., you're just using it for asset protection purposes. The trust is considered grantor, which means for income tax purposes, it's ignored. So it doesn't exist. You tell the IRS I have a foreign trust, it's grantor. There's no There's no income tax issue. There's no transfer tax, no nothing. You just fund the trust. That's kind of the end of it. You just have to be a little careful though, because if you use this foreign trust for estate and gift tax purposes, you could run into a pretty serious dead end, which is I transfer assets out of my estate, and for the moment, while I'm alive, it's ignored. But when I die, it's no longer ignored, which is called grantor status. Now it's actually considered a taxpayer. It is not ignored. And if it is not ignored, there is a deemed sale of all assets transferred to the trust. So this happens for US people if for whatever reason there's no US beneficiary. If you transfer all the assets into the trust, it's as if you sold everything. That is told that does not occur until death if there's a US beneficiary. But there's no tax, even at death, if those assets are in the US estate, taxable estate of the grantor. So assets go over, they're ignored. There's a trigger on death, which says they're deemed sold unless they're in the US estate. So if you move them out of the estate and there's no estate tax issue, they're not in the taxable estate, they're deemed sold. So basically what's going on here is we don't use a foreign trust for US people as an estate and gift tax vehicle usually because of that issue. But you keep those rules in mind more or less now that we've gone through them for the foreigner because they do apply. So it's kind of like what they implemented, if you have no beneficiary or at death, is this idea of expatriation, tax expatriation, where when stuff leaves the country, the IRS gets upset because they can no longer tax it, and so you have to pay as if you sold everything. So then we go to the foreign trust and the foreign grantor, right? Non-resident, non-citizen. Of course, what we're getting to is this person's going to come into the States. So for the moment, they're foreign. They're non-resident, non-citizen. They set up a foreign trust. Remember the two big wonderful things that occur if you're not a U.S. citizen or resident is that you can buy and sell stock, and all your foreign income is not touched by the IRS, got no situs to the US. So if we set up a trust as a foreigner, we've got two options. One option is it's ignored. It's just me setting up my trust and the trust is ignored. I'll pay all the income tax. Or it's respected and it's its own entity. So if we look at this one, it's a non-grantor, that's the one that's respected. It's taxed as a non-resident alien, and it gets those benefits. There's no U.S. capital gains, and there's no tax on U.S. source income, right? The drawback to it's respected, it's its own entity, is if we have U.S. beneficiaries and income comes out, the trust makes distributions, those beneficiaries are taxed. You kind of have to send all the income out. It's tax. If you don't send it out, there's another little tax that they're taxed on accumulation. It's better than being US. In other words, it is better because you still avoid all the tax on onset of capital gains and all your foreign income. But they have to pay the tax when it comes out to them. If it's grantor, which means it's ignored, then it doesn't exist. You've got this foreign trust where you have beneficiaries and it does its asset protection rules, and the foreigner has funded the trust, but we do grantor, we fully control the trust, so the IRS says, no, we're just going to allow this grantor to be the taxpayer for income tax purposes. and we still get all the benefits of foreign source income. We don't pay tax. We can still buy and sell stock tax free. And because it's the foreign individual and not the trust, no tax on distributions. It's totally sheltered out. So the idea is if you're foreign, you go with this foreign grantor trust and you shelter all of this stuff out for your US beneficiaries. That's the key. So the moral then, we'll get to the last 15 minutes or so, is how do we shelter those benefits while still deciding I want to go move to the US? This talks about some of the treaties. The treaties are touch and go. We can shelter a lot of stuff if we we decide, okay, we've decided to become a resident of the US, or we don't want to be taxed by our home country and the US. A lot of it is, I had noted here, we have situs treaties, which is like, I have assets in the US and I live in France, and the treaty says I only have to pay tax in France. Or domicile treaties, it has to do with I'm taxed where I live. That's who takes control. There's some complexity to it, but that's who takes control of me as a taxpayer, and you don't pay double tax. But that doesn't really solve this idea of you. I mean, almost never solves this idea of I'm foreign, I'm taking advantage of all these great IRS exemptions, and I want to come into the U.S. Also, you typically have an issue like with a CITES treaty. It's interesting academically. It comes up once in a while where, someone will say, well, I'm benefiting from the CITES treaty. I have stock in a US corporation, right? And my country says that if I have the certificates in France, France taxes it, and I'm exempt in France for whatever reason. But the U.S. says, no, no, no. I don't care where you have the certificates. It's a U.S. company, so it's U.S. situs. So we're going to tax it on death. There's a conflict a lot of times. I made that up, but there's a conflict a lot of times on how different assets have situs through the treaty. And so sometimes it's very imperfect. Here are your estate and gift tax treaties. There's income tax treaties as well. There's gift tax treaties. And then you have the differences in situs and domicile. This comes out of my book. I can send anyone who wants a book. I've got a book on asset protection we put out several years ago, and 2 books on the foreign tax. If you want that, you just let me know. That contact information will be at the end of the slideshow here. I want to get to, before we run out of time, I know we got about 10, 15 minutes. When I mentioned compliance before, it really had a lot to do with 2 things. One was we unintentionally created a foreign trust by letting Uncle Joe in Holland be the trustee. Now we have a foreign trust. This form 3520, it's this matching form where if we have a foreign trust, the trustee has to file it, the beneficiaries have to file it, sometimes the grantor has to file it. It's so that the IRS knows exactly what's going on in that trust. It's quite a lot of information, and you have to file it every year. All those people have to file it every year. Here's the idea here where the foreign grantor, the beneficiary statement, all these things have to match up. Some of the due dates differ. You really have to have an international CPA do this. It's a little bit of an expense, but I got to tell you, if you don't do it, you get all kinds of problems. I've seen actually people give up their foreign assets just because of the penalties and interest. We also have the basic filings, which is your FATCA and your FBAR. If you have foreign assets, I know the professionals are on the line. I don't want to spend too much time, but if you have foreign assets, you have to tell the IRS. If you have foreign assets unrelated to bank accounts, you've got this FATCA filing, which is essentially $50,000. If you've got more than $50,000, you start to trigger the FATCA filing. And the penalties are fairly onerous. There's been a lot of cases because the IRS went a little overboard with taking everyone's money just because they had a foreign account. So they've been toned back a little bit. But the penalties are fairly onerous if you don't tell the IRS you have foreign asset. And then FinCEN, that's its FBAR filing, is a much lower standard. If you have a foreign banking account, it's at $10,000, you know, at all, you got to tell the IRS. We typically just get this on the backside. Everything we set up offshore, we set up with a foreign CPA, you pay a local, you know, a domestic CPA that knows international, and the banks we use and investment advisors all are aware of the tax filing. So let's get back to the immigrant. The idea is we don't want to bring the assets in. We've funded the foreign trust, right? Now, how do we get in while preserving this idea of limiting income coming in with foreign source income out and capital and avoiding capital gains? Well, we can do what we said. We can remove assets initially, intangible assets. We can just give them away to the kids. A lot of people don't want to do this. Even more so, I find in the practice, people in the US are more inclined to gift and give access than people abroad for whatever reason. For whatever reason. Sometimes we combine these trusts. We can do all kinds of different things for different beneficiaries. And typically with a non-resident non-citizen coming in from another country, they want access to a fairly substantial amount of their wealth. They definitely don't want to be in a position where they're uncomfortable, and we keep that in mind in these plans. But you can give away these intangibles at no tax at all. Remember, you on intangibles and on foreign assets, there's no gift tax. It's just U.S. assets. You can also sell, by the way, before you come in, you can sell appreciated assets. Obviously, you want to avoid U.S. capital gains. That is a good point down there. So, you know, as a summary, that's what you want to get involved with. You want to check the treaty. You want to make sure that you get all your intangibles out, your stock sale exception there. There is a withholding on income, but that's really not a huge issue in terms of becoming a U.S. resident because you're going to get taxed anyway on income when you come in. There's only two ways to get taxed. That's just effectively connected. If you've got a U.S. business, that's income effectively connected to a U.S. business, or if you've got rental or interest income. Now, a lot of the interest income we can get out before you come in. It's not taxable. So what I wanted to get to was this piece here, which is somewhat complicated in that the reason I went through this idea, if you're a U.S. person and you move assets into a foreign trust, it's ignored until you die if you have a U.S. beneficiary. And then if you die, there's no tax if the assets are in your estate. But here's the rub. Here's the rub. If you're foreign and you decide, okay, I want to do some pre-immigration planning, you're moving those assets into that foreign trust in an irrevocable way. You are getting those assets out of your U.S. estate so that when you come in, you don't have a U.S. estate. There's no tax. You're not worried about the exemption amount. You're not worried about anything. There is no U.S. estate. But you run head first into 684. So if you can wait 5 years after forming your foreign trust and funding it to become a U.S. Income tax benefit and income tax resident, if you can wait, you're free and clear. This deemed sale thing on 684 is an income tax. So if you can hold on that and not spend 100, let's say 120 days a year in the U.S., you're going to skate. You're going to be able to get all the assets out of your estate, and you're not going to be subject to 684, which says when I fund a trust, there's a tax unless I have a U.S. beneficiary. And then that tax is told until I die. When you go, if you come into the States, you have a U.S. beneficiary, you're okay, except when you die, you don't have any taxable estate. So there's going to be a deemed sale of those assets, not related to the estate tax, a deemed sale of those assets when you die. We don't want that. We don't want that. That's your challenge. So lo and behold, 90% of the people that come see us, they don't want to wait 5 years. They've got the kid, all of a sudden there's a grandkid, and then, so some of them are practical and they spend 100 days and then they bring the kids and the grandkids out and they don't have to spend it in the US and everything's good. But others are just, I'm moving here, I've already bought the house. Oh God. So they've got to deal with the idea that now what the IRS says is, okay, if you didn't wait the 5 years, when you come in, we're going to deem it as if on that day you transferred all the assets to the foreign trust, even if you did it a year or two before that day. If you don't have U.S. beneficiaries, which would be crazy, then there's a deemed sale of all assets. But you're coming in because you have U.S. beneficiaries. So if you've got U.S. beneficiaries, okay, we're going to toll this tax, right, until you die. There's no mark-to-market deemed sale until you die. So that leaves us with some choices, right? And the choices are, I'm not going to do this. In other words, I'm going back because I've got $200 million in this trust and it's going to clip when I die, and the IRS is going to lean everything out and it's going to be like $80 million of tax. So I'm going back. You guys, we'll figure this out. We'll get a house somewhere else. Or you domesticate the trust, right? Here's your sign on your problems, right? Deemed sale at death, right? Big problem. I can go back, abandon, or I can domesticate the trust. Now, if I domesticate the trust, all of those estate tax transfers hold. I got all of the assets out of my estate, right? But if I domesticate the trust, any deferral or avoidance of the income tax, the sale of intangibles, all these things as a foreign trust and its own entity goes away. Now I've got a U.S. trust. A U.S. trust, it's also taxed at a little bit higher rate. Now I've got a U.S. trust. I've gotten my estate and gift tax out. I've got a U.S. trust, and it's gonna pay tax at a higher rate. It's gonna make distributions that are all taxable. Any sheltering I was doing on the income tax side is gone. So it's a decision. And what happens is you actually run the numbers with respect to, am I going to domesticate, or am I going to go back and not be a U.S. income or estate and gift tax resident? And that's kind of the way it is. I think we have a wrap-up slide here. Oh, this is if you came in and you didn't have beneficiaries. It's an immediate mark-to-market tax, which is very uncommon. You wouldn't come in otherwise. And that's your recap. So it's grantor status, right? While you're in the States, you move in, you don't wait 5 years. If you wait 5 years, you're all set. If you move in within the 5 years to the States, you become a U.S. tax resident. If you've got the U.S. beneficiaries, you're in grantor status, which means you're just taxed on it. But when you die, there's a deemed sale, which you don't avoid because you don't have any estate tax assets in there. So you can abandon it or you can domesticate the trust. So when someone's here, let's see, we've got about 5 minutes. So when someone's here, and they've either done this or haven't done this, or they've partially done it. That's very common, by the way. They partially do this, which is better than nothing. we kind of start to deal with the idea of US tax planning for the immigrant. And sometimes it looks just like US planning, sometimes it doesn't. People, everybody's different. So what we do is sometimes we say, this is a very wealthy person, we say, well, okay, now that you've left some assets in your estate, how much money do you need per month? And a lot of times, actually, a lot of times we can narrow down to what the matriarch and or patriarch need. And if we can do that, we can give assets away into a trust and retain an interest. And two of those, we only have a couple minutes, but two big ones are the GRAT, which was a grantor retained annuity, which allows us to form a trust for a term. We fund the trust, and for a term, we keep back a payment. And the payment reduces the value of the gift way down. So it could be a very big funding, but if we keep a big payment, the value of the gift goes way down. And remember, now that they're US people, they get the $13 million exemption, at least for a couple years now. And they use that up, and we get the rest of the assets out, and they keep the income. Usually works pretty well. Some cultures, at that point, it's kind of over. I mean, what happens is we're successful on the foreign trust. They've gotten a ton out, and they're done. They're done. They're not going to give up, the last $5-10 million because they want access to it, and that's totally understandable. Other cultures, they're like, well, I'd like 50,000 a month, and I want it set, and I don't, I just want to wire it in. Here's what the financial planner does, and I have access to it and a credit card, and I'm finished. I don't have to worry about it. That's very common too. So we do a GRAT. 50,000 comes in every month. They spend the money. We want them to spend the money. We don't want any more estate tax. And that asset's been basically pulled out of the estate if they outlive the term. So sometimes we're worried about if they're going to outlive the term. We can do a 2-year, a 6-year, and we can divide up the term. So make sure even if they don't outlive the longest one, they've outlived the first 2 grats and gotten most of the assets out. That's kind of the grat. This talks about the zeroed out grat, which is where we kind of figure out if we increase the size of the annuity payment, we can actually make the gift almost zero. This is the same idea. It really is related to interest rates. And I think the rule is, as interest rates go up, it becomes even more efficient in some ways. This is more on the grat and the zeroed out issue. You can also, a good comment on this slide, obviously Tony can get you the slideshow. A good comment on this slide is you can make these grats, grantor, which is that disregarded. So you give out the gift, you take back the annuity, but you pay the tax on the income the whole time. You pay the tax on the trust asset, on the actual income, which is, once the trust starts making income, it can be a substantial gift, which you don't pay gift tax on. And so this is the QPERT. Yeah, this is the QPERT, which is the same idea. We'll wrap up with this. Whereas we take a home or a vacation home and we put it in trust. Usually, this is a very painless thing, right? We put it in trust, and mom and dad keep using the house, but it's in trust. And then for a period of years, mom and dad have to survive the QPERT period, the retained period. Let's say it's 5 or 10 years. If they survive it, then it drops permanently into the trust for estate and gift tax purposes, and it's out of the estate. If mom and dad want to keep living there, they can, no problem. They can swap the house out for another house, no problem. It's very flexible, and you can get a house out. The same idea where you put an asset in and you keep an annuity. Instead of the annuity, it's use of the house. Very interesting strategy. And that this goes through some of the advantages of the Cooper. It's kind of a seamless, nothing happens. Mom and dad stay in the house, and the house goes into the Cooper, and they've got to outlive the term. Once they do, it's out of the estate. It's kind of uh, straightforward. There's the advantages of the grat. Um, you have the thing with the grat is you want to probably do more than one because you have to outlive it or it comes back into the estate. That's true of the Cooper as well. This is the Cooper. Very few disadvantages of this. Sometimes you can play, you have to be careful because you get a step up at death, which means on some of these assets, if you pay the estate tax or you apply the credit, the death fair market value is the basis that the beneficiary receives. Whereas if you transfer, they get only your transfer value. Usually it works. Usually you want to transfer anyway. But if you have credit left, you've got to play with that issue. So let us know if you have any questions. That's about it. We left a couple minutes for questions. My contact information is at the end. I had noted we've got a few books on asset protection and foreign tax focused on estate and gift. If you want a book or you have any questions, just let us know.